every last molecule. He's arguably the most powerful man in oil and made a colossal declaration. Recently, Saudi Arabian Energy Minister Prince Abdulaziz bin Salman vowed to drill every last molecule and be the last man standing in the oil world. It's a bold statement in a world that has become fascinated with hydrocarbon reduction. Calling consensus building amongst his OPEC counterparts and Russia a state secret and art, the prince has orchestrated an impressive return of oil prices since the 2020 pandemic, with prices gaining nearly 40% year to date. This sent the shares of oil producers rocketing higher, many of which are up 50% or more this year. Global oil production growth has remained muted, while global oil consumption has continued to improve. This has led to a tighter oil market, which has strengthened prices while stabilizing national and corporate balance sheets. Designed by the prince, last year, OPEC and Russia implemented a massive 9.7 million barrel per day production cut in an effort to thwart massive declines in oil demand and to support crumbling oil prices. The chart you're looking at right now shows the historical production of OPEC and Russia. And its production daily is in millions. You can see the big decrease during the pandemic in 2020 and where it is today. But the long-term potential to 45 million barrels per day is very possible. The production cut worked, and upon the initiation of global vaccine rollouts, oil demand increased while oil inventories around the world began to decline. Today, the world is undersupplied by approximately 1 million barrels per day. It's a far cry from the pandemic demand levels in March to April 2020, when the market was oversupplied by 20 million barrels per day and when we saw negative oil prices. The chart you're looking at right now is broken down to explain the dramatic shifts in imbalances between the oil supply and demand balance. This is in barrels per day in millions. So when green is in surplus, red is undersupplied. But let's look at oil inventory. Inventory levels fall when demand is greater than supply. Barrels normally held in inventory are released to the market to soak up the excess demand. Global crude oil inventory levels had declined by over 200 million barrels. And it is forecast that over the next 3 to 4 months, an additional 100 million barrels could leave storage tanks. The next chart that you're looking at shows the mega buildup in global crude oil inventories, followed by the subsequent decline after the production cut. So these are actually in billions of barrels in storage level. And you can see from the pandemic, when the demand hit, the OPEC plus, the plus stands for and Russia, cut production rates. Falling inventory levels indicated demand exceeds supply. And then the hash marks are our own Katusa research estimated levels. You'll notice in 2022 plus, inventory levels are forecast to rise and likely peaking between 2.9 and 3 billion barrels of oil storage. Inventory levels in this range indicate a normalized market when compared against demand considerations. This can be shown through the days of demand indicator. Just like I've done for gold and copper and all the other commodities, we can do the same for oil. This is a ratio of the crude oil inventory levels to crude oil demand. And that's the chart you're looking at right now. The blue line is the OECD, right? The first world, the developed world in demand in days. The vertical axis is days. The red is global demand days. And you can see that the market is normalizing. So let's get into the numbers. Peak demand plus peak supply equals peak nonsense. You will find a lot of extreme sentiment in the oil market these days. It seems that every day there's both peak demand and peak supply hysteria. Kind of remind you of the gold market, peak gold. So who's right? Probably neither side is right. The truth is somewhere in the middle. Simply put, if we removed all fossil fuel consumption today, the global economy would crash to a halt. That's just common knowledge. Will we eventually wean ourselves off of hydrocarbons? Absolutely. But it requires slow and calculated change, not flipping a light switch. Electric vehicle adoption continues to improve, and that is a key driver for future oil consumption. Though for the next 5 to 10 years, EVs won't displace more than a few million barrels per day of oil demand globally, which is less than 2%. Don't forget the US shale factor. The concept of peak supply is heard just as often. Many questions whether the US shale revolution can continue, or can the Saudis really produce enough oil to supply the market? For years, I've said to never underestimate US shale. It takes roughly 6 months to bring a US shale well from initial spud to commercial production. This creates an incredibly flexible production environment and allows producers to make decisions over much shorter time frames than offshore oil producers or state-owned national oil companies. Shale is a mature industry now, believe it or not, which means the focus has changed from a growth at all costs approach to one of disciplined capital spending and free cash flow generation. As a mature industry, the years of 20 plus production growth are gone, likely to be replaced by 1 to 5% of annual growth production. Other segments of US crude production will likely tread water. Alaskan production has not grown in 5 years, while the Gulf of Mexico is only up a slight smidge. Current oil prices do make economic sense for increased shallow water production in the Gulf of Mexico, but most of this production is controlled by the mega oil corps like Exxon, Chevron, BP, and Shell. As you may know, these companies are under so much environmental scrutiny and forced changes that it is unrealistic to expect large growth in offshore oil. Thus, it's unlikely to see the Gulf of Mexico oil production rise significantly. Most, if not all, US oil production growth will come from the shale rather than conventional sources. OPEC and Russia have considerable excess production capacity, which can and will begin to flow back into the markets. Starting in August 2021, the group will collectively increase production by 400,000 barrels per day, not counting the cheaters of the group. Remember, there's always a cheater. Each month for the rest of the year, the group will add an additional 400,000 barrels per day to the market. Remember, that's every month for the rest of the year. The goal of this slow, disciplined approach is to try to orchestrate and keep oil prices near the $70 per barrel range. So you must ask yourself, how much oil can OPEC and Russia bring to the market? The current OPEC excess capacity is over 8 million barrels per day. The largest contributors to future oil supply are Saudi Arabia, Iraq, UAE, and Kuwait. Iran has the capability to also add another 2 million barrels per day of supply, but this hinges on their nuclear deal with the US. Furthermore, Russia has at a minimum of an additional million barrels per day of additional capacity available if the price is right. So this chart you're looking at together, we've put together of all of the OPEC plus, so that's the OPEC and Russia. And really you look at the blue, Saudi Arabia, Russia, with a minimum of 1 million barrels. We're being conservative here. Don't worry about the supply, it's there. Even if you exclude any of the smaller OPEC nations citing poor infrastructure, just the core group of Saudi Arabia, Russia, UAE, Iraq, and Kuwait provides nearly 6.5 million barrels a day of spare capacity. This is enough to satisfy the incremental global demand growth for several years. Now I want to talk about huff and puff. No, not the children's story. This is actually going on. You will hear a lot about huff and puff technology in the coming years in the oil patch. Contrary to what many tried to sell you on, it's not a new technology. In the US, you will start to see more oil produced through the EOR, enhanced oil recovery techniques, specifically the huff and puff technology, which uses CO2 injection to pressurize the formation and bring oil to the surface. This CO2 injection is eligible for a tax credit under the 45Q tax code. You accountants paying attention? I've done a lot of number crunching on this, and I don't see, barring some new breakthrough that is many years away, the carbon credit cost being less than $40 per ton in the most optimistic model in the oil patch. That gives us a framework at what price oil companies will be forced to pay for their carbon offsets. And if you're not factoring that into your investment portfolio yet, you're going to fall behind. Subscribers to the KRO, my premium research service, know the oil companies I'm targeting and how I'm playing the net zero world in a big way. I've actually found a company where the CO2 used to produce its oil is equivalent to taking 8 million cars off the road for a year. Now, members have the ticker and all the information. It's up to you to do the rest. Stay safe.